Hi guys, for the first time, today's guest on Athletes Capital will be a woman. She is a professional investor and invests in our favorite asset class, which is sports.
I think probably one of the things to mention is that I ended up in finance a bit by accident.
We spoke with her about investing in sports, the role of women in business and sports.
Many women, myself included, would have tried to emulate and be men, and because you see the people at the top, the leaders who are men, and so you try and use them as role models.
And also what athletes should do with their assets.
We are focused on investing in undercommercialised sports.
Don't forget to subscribe on our YouTube channel and follow us on social media. Let's go to the episode. Okay, Nicki, welcome to Athletes Capital.
Thank you. Good to be here.
First of all, I want to appreciate your participation here because, as I mentioned, you're the first woman that I'm going to interview and talk with. And second, I know you have really interesting stories to share here, and hopefully we can provide some value for the athletes and especially for the women in sports. So let's start with the basic question, and why don't you tell us more about your background, and we'll take it from there.
Sure. So I think probably one of the things to mention is that I ended up in finance a bit by accident. I'm a farmer's daughter. I grew up on the south coast of England, and so I didn't have any exposure to. I had exposure to business. I would still call my dad a businessman, but I had no exposure to traditional finance, the city, etc. Was on track to be a doctor. Studied medicine, and then decided that I didn't want to do that, and so ended up sort of tripping into consulting. That's how I started my career. So management consulting in London, and the firm I was working for happened to do a lot of work for private equity, and that's how I discovered even what private equity and investing was. And so I quickly jumped upstream as I called it. That started, what has been the last 20 years as an investor. Firstly, for a generalist firm called Inflection, based in London. I then spent actually 5 years on the west coast of the US at business school, and then taking a education technology business through to exit. Then came back to the UK, co-founded a new investment vehicle called Apiary, generalist investor across a range of different sectors, but always in growth businesses. That's where I've mainly operated. And then a few things transpired, most notably when my daughter arrived 3.5 years ago. I realized that I loved investing, I loved working with management teams and really partnering with them to create value in their businesses. But I wasn't really passionate about the end markets, the sectors that I was investing in. And that led me on a journey and ultimately a decision to reorient my skill set towards sport. I've never been a professional athlete, but always a competitive amateur, let's call it. And it's been a huge part of my life. I credit sport with equipping me with all of the skills that have enabled me to succeed professionally in principally male-dominated finance environments. Leadership, teamwork, resilience, all of those great things. And I just think sport is uniquely powerful, as a unifying force, and especially in the, turbulent geopolitical environment we currently find ourselves in. People can unite over sport, come together. It crosses cultures. Think about right now with the World Cup, how much that's galvanizing. So many people around the world. And it really felt like, alongside that sort of personal, motivated impact element, that now was the time when there's very strong commercial opportunity. So sport has become established as an asset class really over the last 10 years, probably. Billions of dollars poured in, mainly at the larger end, so what I would call sort of large cap, minority stakes investing in major league franchises in the US, etc. And much less at the smaller end, let's say the SME end of sport. And so that's where that's what we set up Sphera to focus on. We are focused on investing in under-commercialised sports, emerging formats, women's sport, where there's significant structural opportunity, some growth tailwinds. But those assets need not just capital, they need hands-on operational support as well. And that's what really excites me. So that's my journey to where I am today.
Where you touched on a lot of interesting topics that for sure we're gonna dig deeper. But let's start from the first one. And what is your opinion about women in sports? I mean, there's in business as well, because I think now there's a big wave coming up, and probably you're part of it, where more and more women are becoming successful in sports and in business. So tell me, being part of it, what are your thoughts about it?
Yeah, for sure. So, I mean, when I started in business, 20 years ago, and as I say, especially finance, I was, often the only woman in the room. All of those great stories about the assumption that I was the PA and won't you make the coffee and all the rest of it. And honestly, I credit the fact that I'd done sport with the fact that I didn't let any of that get to me. In fact, arguably I didn't even notice much of it. I think for me, rightly or wrongly, it was another sports field. It was another place to compete. And so it was about just, putting your head down and getting on with it. Now, finance and private equity specifically, there's been concerted efforts to attract and retain women. So it has shifted, but the stats, I'll just take the UK, and UK is actually better than much of the rest of Europe. Probably what back then, I don't know, there might have been 5% women in private equity in frontline investing roles. And now that is probably somewhere double digit teens. So, probably reaching the kind of 20% level. So still a long way to go. And I think lots of recognition that diversity of voice makes better investing decisions. So, and increasingly that being understood. So there is definitely more effort to, as I say, it's about attracting and retaining female talent. As to the sports sector, and I think that the nice linking statistic is, and this really resonates for me, as you will have heard in my story. This research has been done by a number, EY is the research which I have read, that 94% of female execs in business have sport in their background, for all of those reasons that I was talking about in terms of those transferability of skills. So as I think about sport and especially what impact I can have in what I'm doing as we think about investing in women's sport, I mean, yes, of course, I would love women's professional sport to have a greater stage, as indeed it is and will continue to have. Particularly in the US, we've seen, huge acceleration around women's football, soccer, the NWSL, and women's basketball with the WNBA, and some really great watermarks being achieved with Angel City, the women's football team in LA, reaching record valuations with the Valkyries, the women's basketball team in the Bay Area, reaching the kind of $1 billion valuation mark. So all of that is great, and it's great that women now, have, will start to have a choice and a path to have a career as an athlete in a way which 20, 30 years ago, unless you were in tennis, you probably didn't really have a viable way to make earnings. Lots of women were playing sports semi-professionally. They had a job on the side. They were hustling to make it work. And important foundations were built during that period, and we must be thankful to them. But beyond that, I think what's really important and exciting is the impact that having those role models with more development of women's professional sports will have on particularly young girls. The phrase "you've got to see it to believe it" I think is really true, and the more we see women in those positions with strong bodies, with healthy bodies, we can think about some of the female athletes who've become role models: Caitlin Clark, Ilona Maya, Chloe Kelly, and I think that's incredibly healthy for young girls, especially in a time of social media. So even if they don't continue to play professional sports, and we know it's a steep pyramid, hopefully the increase in participation, and particularly continued participation. Historically, girls have dropped out of sport at twice the rate of boys as they hit their teenage years. If we can address that, then we'll be breeding more healthy female adults into society, and ultimately, I believe, driving a more equal society.
I love what you're saying. If you can give a genuine advice on a woman that is just getting into the corporate world and probably people are treating her, as you mentioned, as PA or something like that, what advice would you give her? What she can do in order to implement what you said and to adapt quicker to that environment?
Yeah, and I think I would, sort of slightly sadly and reluctantly, I would say, remember to focus on the things you have the power to change. So, you can't change your ecosystem with the click of your fingers. If you're in an environment which is too unhealthy, ultimately you can take yourself out of that. But environments won't be perfect. I talked about how much private equity has improved, but it's still, you hear plenty of, horrible stories. And my advice to women, junior women starting out is, that there will be some, let's call it friction, some challenges. If the environment is what we'll call toxic, then get yourself out of it. But we've got to deal with challenges. Sport will have set us up to deal with challenges and focus on the things you can control. So a few things. One is be authentically you, lean into being you, and be confident in that. I think many women, myself included, would have tried to emulate and be men, and because you see the people at the top, the leaders who are men, and so you try and use them as role models, and actually trying to be something you're not, and not leaning into your strengths, doesn't. It's not the most empowering thing to do. So definitely lean into yourself, be confident in yourself and the strengths that you have. As I said, that diversity of voice, being recognised, not to be too gender stereotyped, but women will often have higher EQ and be able to pick up the nuances of interpersonal dynamics better. So that there are strengths and weaknesses to lean into. I would say find advocates and allies, and that's both people who are at your level within your firm and at other firms. A support group, if you will. It was a much smaller cohort at the beginning of my career, but there was a collection of us, women in private equity, many of whom are still in the industry, some sadly left, and many of us are still really good friends today and have supported through our careers, be that to moan to, have a glass of wine with, to benchmark salaries, to practice negotiating, and then similarly, as I think about advocates, I think about mentors. So finding mentors, and again, I've had mentors within firms I've worked for. I've had mentors outside firms, and they play different kind of roles. But can be really valuable to help and advise, advocate, and support if they're within your own firm, champion you through your career.
I hope more women are listening to that podcast, because there were a lot of gems what you said. So okay, you said you chose private equity. Just tell me quickly, why did you choose private equity instead of public?
Honestly, I did. There was a bit of naivety. There was some, as is usually the case, there's some accidents, luck, one might call it. So as I say, I started in consulting, and the consulting firm I worked for, we did strategic corporate consulting, and we did commercial diligence work for private equity firms. So I was getting exposure to private equity rather than public markets. And I thought it was really interesting that the element we were doing was, what a commercial diligence project entails is, 4 to 6 weeks where you're working on, building a commercial or rather validating or invalidating the commercial elements of a business plan. So you're building a report for a private equity firm. And I loved diving deep, and actually those 4 to 6 week projects over the 2 or 3 years at the start of my career, I got exposure to an enormous amount of businesses, different revenue models, good practices, bad practices, etc. So it was great learning. But what I was getting frustrated about is I would develop all of this, knowledge and learning about a business in a segment, and then we sort of drop it and move on to the next thing. And so my motivation actually to move into private equity was what I saw at the time. I saw that those investors were getting to continue to work with that business over a period of time, over a period of years, and so developing that knowledge and then applying it, but doing it in a plural capacity. So with a portfolio of different businesses, still some exposure to different businesses and different segments, and that sounded really exciting and appealing to me. So that was ultimately why I, as I say, jumped upstream. And so I never really considered public markets. Public markets have always been part of my personal investing portfolio to ensure I have balanced diversification. But I definitely don't consider myself expert in that domain. I'm more sort of tracker fund-esque rather than individual stock picker. So yeah, didn't really come into the kind of frame.
Okay, so right now you're investing through Sphera Partners, right?
Yes, that's right.
Okay, and Sphera is in a really interesting vertical because basically it's in sports. And I would like us now to talk more about that because I'm also very interested to understand more, first of all, about what you're doing. Why did you choose that asset class? Where are the opportunities? I mean, tell me everything we need to know about Sphera, about the assets that you're investing in.
Yeah. So as I touched on briefly in the intro, I'd observed that there's been a lot of money coming into to sport, over institutional money coming into sport in the last, let's call it 10 years. There's always been money in sport. I think, if we roll back, many more years than that, one would consider it the domain of, individual high net worths, as, sometimes, trophy assets, when you've got when you've got plenty of money, where else might you put it? You might put it around your passion. So that's how it'd been, I think, originally thought of. And then some of the first institutional investors, or indeed some of those high net worths who were smart investors, I think, realized that it was more than that. What the data shows, and the data generally over the long period is done on the major franchises in the US, because we have that data, and compared against public stock markets. And what we see is that if you take that as those sports indices, we see stable growth, long-term growth over time, and resilience to some of the economic shocks. So the global financial crisis, when stock markets would have crashed, and sports was resilient through all of that. Similarly through COVID, similarly through Brexit, through the current geopolitical times. And it makes sense, socially, culturally, sport is such an important part of many people's lives. Someone said to me the other day, football is more influential than religion these days. I didn't challenge that quote. And so, when you've got that backdrop, from an investing perspective, that in itself is quite attractive. And then, as I say, some of those early investors, realized that actually people have been making money by being, passive, relying on, growth and interest of fan interest, increasing media rights deals over time with those sports assets. But actually there was active ownership that could be layered on top to further drive growth in revenue and therefore value. So merchandising emerged as a huge revenue driver over years. Player trading, so developing talent, and the revenue streams that come off that. So that started the snowball effect of institutional capital coming into the sector. Still plenty of high net worth, but institutional capital coming in. But it was initially, it's really, and still, lots of activity around taking, as I say, minority stakes in some of the major league franchises. So, minority stake in an NBA team or a MLS team, etc. And then what's emerged off the back of that is thinking about the sports sector and rights holders, and then ancillary revenue streams more broadly. And as I say, where we've decided to play at Sphera is in recognition of the fact that there's a higher concentration of money at that very large end. And in line with the skill sets and experience I have at operating at the more kind of SME growth end, we decided to focus our efforts and our investing thesis there. And that is also where it's a more benign competitive environment, and where we think that there are really outsized returns to be had, which is always exciting. So as I said, it's about both capital and it's about working with those assets, be them rights holders or, as I say, kind of ancillary businesses, to think about both, what I'm going to call, good business practices, be that around the management team, the organizational structure of the business, be that around the infrastructure, so governance around KPIs, technology, financial reporting. And then, of course, there's sports specificity, and there we within our own team we have a number of advisors who come from deep within the sports industry, and then of course within the assets we're backing, there will be plenty of sports operators and experts as well. And so that partnering those skills of what I'm going to call generalist business building skill sets across a range of different sectors, and you learn lots of things by working across a range of different sectors, with what are some of the specialisms and nuances of sports itself. So in terms of putting tangible examples to that and where we're focused and what we're investing in, women's sport, as I say, good example. Certainly under commercialized historically. It's not a moment of growth. We believe it's now got momentum of growth. There was a starting moment, but there's now momentum to growth, and that will continue for the long term. So there's some tailwinds, but lots of these women's sports assets have really had no attention whatsoever. So let's take again women's football by way of example. Many within Europe, women's football teams are owned and operated within the greater men's club, and with absolutely no disrespect to the men's club owner, it takes a lot to run a football club. And so the women's, because it's so small in comparison, is getting no attention. And so even where those owners really believe in the opportunity around the women's, they just don't have the capacity, and indeed it doesn't make business sense given the relative scale to spend the time on that. So that's where we, and there are some other operators with a similar thesis, come in, where we can say, look, we will provide both capital, but also we will be 100% focused on the women's team. And that's what it needs. That's what anything needs. That's what any business needs. It needs 100% focus to optimize its potential. So that's one example. Another example, and this is a men's and women's sport that we're spending some time on, is cycling. So, cycling, and there are some peaks in cycling, the Tour de France, obviously globally very valuable and watched assets. But, step away from the Tour, you don't have to take many steps down to for it to be not very well marketed, publicized, watched, monetized. Yet we believe, has all of the foundational elements that mean it's ripe for that. And so we're spending some time, as I say, looking at men's and women's cycling and where we might play in that ecosystem to optimize the commercial potential of that. And a final example, women's basketball. So we invested in a new women's basketball league called Upshot in the US last year. Upshot is set up as a development league, really to develop talent for the WNBA, which is, on its own explosive growth journey. And Upshot is it's a professional women's league, so the women are getting paid properly. having a chance to play, beyond college, or indeed come from overseas to play in the US, with a hope often to get scouted for the WNBA. The business model there is not about media rights. It's about sponsorship, and it's about fandom. So building, almost community, although community makes it sound a bit small if we think about the scale of the US and a number of the more sort of second tier cities which don't have professional women's team. These are large markets in and of themselves, but it's about that's the revenue model is developing around that.
If I can summarize that, you're actually investing in assets that are suffering, so-called, from attention from their owners.
Yes. Yes.
You're buying a minority stakes.
We are. So my background in private equity is taking majority stakes in businesses, and so we are. And the advantage of having majority stakes is that you have sufficient control to drive real change. The challenge with minority stakes often is that you don't have unilateral control, and if there is a lot of change which needs to go on, you're a passive participant in that. Now that can be fine. You're backing, very as a fully formed team, that you're backing strong operators. But in general, we come from the mindset of taking majority type stakes or significant minorities where we have, certainly a seat at the table and a strong voice at the table. We want to be partners, supportive partners to the executives running these businesses. This is not about chucking some money over the fence for a 5% stake and saying see you in a few years, please make my money more. And by the way, I say that flippantly. There are of course businesses where it makes more sense to do that, but where we're playing in this space, we think that we obviously think that our model is the right one to really optimize the potential returns.
Yeah, I agree, because in the space of small and medium-sized enterprises, where you are, if you want to make change, you need to have some influence.
Yes.
In the company, so it makes total change. And I actually think this is a win-win also for the sellers of these type of businesses, because they also don't give so much attention to these type of assets, and you're actually providing capital and the attention that these assets need. Yes. Actually to grow. So what would you say? It's not a saying, I think it's a fact, that most of the sports franchises are actually losing money. And how is that possible? An asset is losing money but actually growing in value.
Yeah, this is a great question. So there are how do I really, let me try and really simplify this. I should have thought about this in advance. So in a business is valued often at a multiple of either its profit or its revenue, and that's the enterprise value, the capital value of the asset. And there are a number of things that feed into that. In the old world I worked in, it was quite crude, and mostly it was a multiple of profit. Sports operates in a different way. Many of these assets are, as you say, losing money, and valuations are often done on revenue multiples. And one of the key reasons for that, how can that be dissociated? How can we be valuing an asset, as you say, which might not be making profit or cash flow? Because we are confident that we're going to increase the enterprise value over time, regardless of the profitability. And the key input to that, the key driver of that is the scarcity value of these assets. So, we're not going to be creating, more football teams in the Premier League, right? So where there is a constrained supply, a constrained number of assets, you can't just start these from scratch. That is one of the key elements of value, which is not quantified. You wouldn't have necessarily quantified in, as I say, my sort of old business world. But it does come with risk, because there's a reliance on the ownership group if something is losing money for additional beyond the purchase of that asset, for additional capital to be injected to support that business to operate if it is losing money. And you are very much reliant on to make money overall on that increase in capital value. Whereas if a business is making revenue and profit, if there's no interested buyers, you can continue to hold that business and that you won't have to inject more money. And ultimately, you can take out some of those profits to start and you can be making money that way. I think Nicola, and you know this as well as I do. I think men's football particularly has got itself into an unhealthy financial state whereby the revenue of some of these clubs is enormous and the valuation's enormous, but as they every additional pound of revenue they make, euro of revenue they make, it goes into buying a better player, buying a better striker, buying a better goalkeeper. And then you have some of the revenue streams. So some are nicely underpinned for a long period of time, media rights distributions, for example. But some elements are not. So the revenues you make from getting into a European competition, winning a European competition. And so if you've built the cost base of a business based on an optimistic scenario of winning the Champions League and some great player trading and making some good money from that, and then none of those things happen, then suddenly you've overspent on a handful of your players in the transfer window, then you can be losing money. And it's very hard to put this genie back in the bottle, honestly. One of my hopes for women's sport, where we've got a much more blank sheet of paper, is that we can try and build it in a more financially sustainable way. So that's definitely part of the key focus for us, is trying to do that, trying to prove that can be done. Partly because it will encourage other people to invest. If women's is just going to lose money as well right from the outset before it's really established, then actually a number of owners of teams will say, oh well, this is not going to make sense for me, I'm just going to close it down. And sadly we have seen some examples of that. So I think setting out to try and build it in a more financially sustainable way, especially football, as I say, really important.
So you're basically saying that the women's football have a good example of what not to do financially, watching men's football.
Yes, exactly. We've got to try and learn. We've got to try and learn from that.
Yeah, there are good and bad examples in life.
There are, and there are some really good examples for men's football as well. Sorry, I don't mean to squash it. In Portugal, you probably have this statistic better than I do, but a large number of clubs here, which many people have never heard of from a brand perspective, make money, and they've done that really by specializing in player development, so scouting players, bringing them through academy, and then trading them and making money off that. So I think I'm going to get the statistics slightly wrong, but more clubs in Portugal, reliably and consistently make money than the whole of the rest of Europe, because they've really focused on that. So that was really smart, recognizing that they're not going to have the size of the domestic Portuguese market, recognizing that it's going to be hard to compete with some of the bigger brands, certainly outside of the top 2 or 3 teams in Portugal. So that's an example of smart decision making, and that's really pertinent right now in the women's game, as we're seeing potentially spending get ahead of revenue fundamentals, particularly around player transfer fees. So we're seeing plenty of players now trading at above the £1 million mark, which is on the one hand really exciting for the game and really exciting for the prospects of women making money out of sport. But yeah, we need the revenue to catch up to support that. And yeah, I think that lots of the smart clubs who are focused on this, really thinking about that talent piece and that talent development piece as a buffer to those rising player trading fees.
Before we finish with this theme, I would like you to tell us how are you evaluating risk with Sphera before making an investment? What do you want to see in the asset that you're actually evaluating, and what are the red flags? And also, in addition to that, tell us, can a regular athlete invest in a vehicle like Sphera, or what is the way for athletes to start investing in that asset class?
Yeah. So I'll tackle those separately. So, in terms of how we think about risk, and I think you need to think about the risk reward balance. And so if I could just frame with, so later stage, private equity investing, and what I was doing before, we were investing in, well established businesses with a long term history of revenue, profit growth, cash generation. You have a lot of data to analyze. It doesn't mean those businesses are 100% resilient, but you've got a lot of data to analyze and you can build confidence around trajectory. It will generally be low growth, not high growth. And so that comes with, what you're expecting in terms of, financial returns, which are moderate. As you move down towards venture, venture is about investing in visionary moonshot ideas, often still just on a piece of paper, unproven at the very early stage. A large amount of those will fail, but a number of them will succeed and deliver very very high returns. The way we think about where we're playing at Sphera is somewhere in between those. So we think ourselves as growth equity investors. So these will be businesses which are assets which are more proven than just an idea, but they won't have many years of established revenues and profits. And a big part of the thesis is we are at this moment of change where there are growth tailwinds which there haven't been in the past. So it's not past equals future, and our active ownership will drive. So will drive an increase as well. So that drives, as I said, slightly higher risk than over here, lower risk than over here, and returns higher than over here, lower than over here. The kind of next level of detail, I would almost say, flip it around and say, we can analyze to death, and that's what we would have done in the past. We will often have limited data to work with here. So sometimes, as well as what are we looking at, the financials, the data, we ask ourselves, what do we need to believe to make this investment? So we would have developed a business plan which will show on an Excel spreadsheet that the revenue does this, and it gets to profitability, and then we sell at this, and it makes us some lovely returns. What do we have to really believe for that to happen? And I will go back to part of what I said in one of my answers earlier about advice to women, which is recognize what you have the power. We as the investor and the asset owner have the power to change. So I think that we have to recognize what we have the power to change as the operators, as the investor, and what we don't have the power to change. So the ecosystem within which we're operating. So it's no good saying, oh, there's a really undervalued football team in, I don't know, I'm going to
Bulgaria.
offend someone. But yeah, there you go. But women's football team in Bulgaria, clearly women's football in Bulgaria is going to take off. You could do everything, all the right things in terms of trying to drive revenue within that asset. But if the ecosystem is not ready for it, then you're always going to be you're always going to be up against it. Within there's a time frame aspect to this as well. So what's the ecosystem and environment you're operating in, the things you don't control? How confident are you that, and what do you need to believe about what's going to happen? Do you need to believe that there's going to be a media rights deal uplift of 100x? And then again, what do we believe? What do we need to believe about what we can do? And there will be an element of sort of benchmarking. And I'll give you an example of something we mustn't do, which one has a tendency to do. So to say, oh, look, Angel City, the women's football team in LA, they went from, zero to $300 million valuation in 4 years. And the revenue went from, X to Y and Oh, we're going to buy this women's football team in a small town in the north of England, and we can do the same. Um, that's just unrealistic. There are some certain advantages and nuances to operating a football team in LA with some celebrities on your cap table versus, small town north of England. So in that exact example, we would be saying, okay, small town north of England, is it a footballing city? Is it a sole team city? What's the catchment population? What's the catchment for fandom? What's the catchment for attracting talent? What other clubs in neighbouring cities do we compete with? What are the uniquenesses of that city? Does it have footballing heritage? Has it developed lots of talent for the England team through the program? Is there a big student population? Is there a big corporate and something that city is known for that we can lean into to build personality, to build community? So I think that there's, to summarize all of that, recognizing what you can control and what you can't, what do you need to believe with some realistic assumptions about what you can't control, and then within what you can control, again, really challenging yourself and being realistic about the assumptions you're making. Yes, looking at other comparables, but making sure you are, not reading across blindly and thinking about the specifics of what you're investing in.
And what about the investment side?
The second part of your question: can athletes, invest and access this asset class? Absolutely. I think for athletes, I'm sure they get approached, they probably have better deal flow than I do, approached all the time about things, and so I think what an athlete probably has to do is be a bit skeptical about what they're investing in, and thinking about their personal risk profile as well. So athletes are really interesting, right? Because in most people's normal career, you're making more earnings as you, in theory, making more earnings as you get older, and generally your spend goes the same way. So you're living according to your lifestyle and according to your earnings today, and then hoping over time, and then you will have needed to build enough for retirement when you stop working. Athletes have this window, better than most, where they are, they might be making, in the case of male footballer, very high levels of earnings, and if they don't invest any of that and just adapt their lifestyle to that and spend, at the point they end their career, and maybe their career's ended early because of an injury and cut short, and haven't about investing and haven't thought about career transition, what next, then that's when they get in trouble. So I think it also depends where they are on that curve. But athletes absolutely have access. If they want to be more passive and have diversification, then going into a fund is a really good idea, because then it's distributed across a number of assets. And indeed, there may be an opportunity to be a bit more active selectively. We've seen some funds partner successfully with athletes. So there's a venture firm called Red Rice Ventures. They've got Andy Murray as an operating partner. More recently, Alistair Brownlee as an operating partner there as well. And so, they are selectively getting more involved with some of their assets where it makes sense to do so. I think what athletes should be cautious of is going, all in too big on certainly very early stage businesses. Making sure they're realistically assessing that if something is a venture business, there's a decent chance that you lose all your money. Of course, that the entrepreneur won't pitch it that way, and you've got to believe that that's not the case. I think it would come down to where an athlete is in their career trajectory, what other assets they have, and therefore their risk profile on as they think about a pool of capital to invest in sports assets. We'd be delighted to speak to any athletes.
I'm asking you this because I would like this asset class to be the investing in this asset class to be more democratized, because sadly, when I was a professional athlete, there were no any opportunities like that. And I know the athletes, actually, they know this asset class and they would like to be invested, maybe not put everything there, but to have some portion of their portfolio to be invested in that type of assets, because as you mentioned, also the opportunity is big there. because they're still underdeveloped. So that's why I'm asking you. And but again, you digged into some very interesting topics now, and I would like to connect now everything what we spoke until now to connect it with the athlete's mindset and to speak through the mindset. In terms of that, my first question will be a bit challenging for you, and I'm interested what you will answer. So I want you to imagine yourself that you're an 18, 19-year-old girl, athlete, professional athlete, and you just received your contract. There are enough zeros on that contract, meaning you can improve your lifestyle, which is something I would like to know your opinion about. I mean, does an athlete has to improve its lifestyle immediately, or it has to happen gradually? But what would you say to that girl that just signed its first professional contract, has enough money in it, but also the girl has to be 100% concentrated on the sport side. So how would you deal with that situation?
Yeah, I'm going to go a bit extreme to make the point. So I would probably say something like, and without knowing the amount, it's hard to say what the exact percentage is, but I'm going to take a stab. I would say take 90% of it and put it in a high interest cash account or something secure, stable for 12 months. Don't touch it. Don't rush into any decisions. You will have, assuming it's a large amount of money, you will have people clamoring over you. The temptation will be to go and blow it on X, Y, and Z to keep up with the lifestyle of another athlete in your team or one you aspire to be. Um, and then the reason I said 90-10 is, of course, there should be an ability to, improve your lifestyle, to, have some fun, let's say, buy a car, maybe not a Ferrari, depending on the number of zeros. Um, so I think that would be my kind of starting gamut, as you say, because they then also need to go and deliver on the pitch. Else, there's never going to be a second contract with that many zeros on. So that enables them to, almost block it from their head. They could tie it up in something which they can't touch for a year, even, a high interest bond or something. And then over that period of time, they will, I'm sure, over that period, have a bit more time to think about, and perhaps a more informed view of, career and financial trajectory, to think more, more carefully about what they do with it. But definitely, let's say you've rolled on 12 months. What are you thinking about now? Definitely, you would be thinking about a portion of that putting into some more long-term investments. Easy stuff is, as I say, sort of public market tracker type vehicles. I would think about property, as well as as you think about the diversification. And honestly, I would only start thinking about, you know fund investments, individual startup investments, once you've laid down some of those more stable foundations.
It makes sense, yes, because I also say to most of the athletes that I'm in contact with that most of their cash should be in something liquid, and there are a lot of index funds that can do the job for them. But as you know, most of the athletes first thing they want to do is improve their lifestyle. Okay, that's human nature, but for sure part of their money should go into investments, and that is the message that we want to distribute here. And also part of their portfolio, because it's interesting for them to go into venture type of investment. And what I mean by that is, especially when I was an athlete, there were a lot of investment opportunities presented in front of us. And my opinion is that one of the easiest people to take their assets out of their pocket are the football players. And only if you show them something that is going to go only higher, and this is what the graphic is showing, right? They're keen to jump on it. But if you're in that position, what would be the red flags that you would look for? What are the questions, and how would you filter that type of investments?
Yeah, totally. I would. Uh, what are the warning signs? If you're feeling pressured or oversold, if there's short deadlines, the reality is you should never feel rushed or forced. to invest in something. If people are guaranteeing you, nothing is guaranteed, really. Even the lowest risk stuff is not guaranteed, right? There's still a risk it may be very low on a government bond, but there's still a risk profile. Um, so so yeah, so that they would be warning signs. I think asking questions like what is it I own, making sure the structure is right. So are you investing in, I won't get into jargon, but are you investing in a safe note? Are you are you actually owning underlying equity? Do you have a unit in a fund? How liquid is it? To your point, when you invest in a fund or indeed any individual startup, you are committing to a time. A fund does have a time period, but it's not guaranteed. A startup is indefinite, right? You're not going to be seeing returns for a long period of time. Asking what the fees are involved in something, making sure they're really clear, like the person promoting it to you, are they a middleman who's getting some cut of all of this? Are they an investor themselves? Are they the entrepreneur themselves? What happens if something goes wrong? Do you lose all your money? And if you do lose all your money, are there any benefits to that, like tax benefits, write-offs benefits to that, for example? So yeah, there's definitely a list of questions, but I would go back to my first point, which is, if you're not sure, don't. If you're ever feeling pressured, if there's a timeline associated, then those are all very very much red flags.
And why I think this type of investment is actually good, what is the good side of it, is that you can actually learn the investment business if you're an investor in that type of company. So
Exactly.
small private equity deal or a venture type deal, and if you want to receive some information on a quarterly basis, for example, from the founder, I mean, you can actually get into the shoes of the owner or of the investor and learn the business earlier, which is the good side of it.
Yeah, I mean, we look at some of the very successful, often American, I'm sure there's English examples as well, American athletes, superstars who've, transitioned into being very active and successful investors. Serena Williams, there's a great example. So, and she obviously made a great deal of wealth during her career, but she started. I don't know the exact story as to when she started making early stage investments, and then has been successful at that, built a fund around it, then been very smart about. I'm sure there's some where she's not involved and it's just a passive investment, but where she leverages her brand, her network to really amplify and change the trajectory. Look at Roger Federer, not to just pick on tennis players, and his investment in On, the shoe brand. And I think that was a crucial, in a very crowded, hard to differentiate market. And actually that brand started as a performance brand, and I would say now as a fashion brand. And I think he was a key element. Activating around him individually was a key element in the trajectory and success of that brand. So athletes are very unique, because it's not just capital. So maybe they want to be just capital, but do they want to be something more than capital? Do they want to just shadow and learn? Do they want to actively leverage their brand and the things that they bring, and by the way, get compensated for that? So yeah, I think they're in an exciting position, but yeah, I'm sure as you exactly said, like, it can be overwhelming if you're flooded with opportunities, all of which claim to be the next SpaceX, and of course by default they can't be.
One other topic that is extremely interesting, and it connects good the sports world and the investing world, are actually the human qualities that athletes are developing through their career. And I think they're really well equipped to deal into the so-called normal world and into the business world, because they're developing discipline, willpower, and all the things that we know that they have to have in order to be professional athletes. What are your thoughts about that?
Yeah. So I thought a lot about this latterly. As I said, I didn't really think about this at the beginning of my career. I think I used the skills I had from sports more naturally, but I've reflected more on it latterly. So I think what transfers really well. So discipline, tolerance from failure, recovery from failure, long-term thinking, comfort operating under certainty, knowing how to peak for big moments. I think what the biggest thing which doesn't transfer well is, and this is not always the case, but sport is much more, I'm going to say, linear. So, the effort you put in generally correlates pretty well with what you get out. So, train harder, run faster. Of course, there's injuries and all sorts of things in the way, but markets don't work like that. You can work harder than anyone else and still be wrong. So I think having patience, especially, and that can be hard, especially where there's strong competitive instinct, there's a propensity to action. Sometimes, the best decision from an investing perspective is to have patience, to not act, to see how something plays out. So I think that's what athletes transitioning probably need to just be self-aware of. So lots of things transfer really well, but just knowing what they need to be aware of and how it might negatively influence their investing decisions.
Yes, and one more really important thing about that is actually sports teaches you how to deal with success. And that's extremely important as well, because obviously failures, we all know that if you're resilient and keep going, you'll dig out of the hole, but so to speak. But also you have to know how to deal with success, and it's, I think it's same in business. The more successful you become, the more humble and on the ground you should learn yourself to be, and sports actually is teaching you that. Would you
Yeah,
agree?
that's a great point. That's a great point.
And you mentioned wealth advisors and financial advisors, and there are also a lot of people like that around the athletes. So if an athlete wants to hire someone like that, and what are the questions that he has to ask him, and how can he filter this person or his company?
Yeah. So uh, often taking personal advice from maybe your athlete friends, but also non-athlete friends, so successful business people and what they're doing as well. So I think personal recommendations strong. Understanding fees. Obviously, there's been in the UK. There's been a lot of scandal over recent years about not consumers not understanding the fees that their wealth managers were charging them, and often putting things in passive products and charging ridiculous fees for that. That's in the UK, as I said. I know less about other markets. That's definitely changing. There's more scrutiny on that, but understanding the fees you're paying. Um, uh, Looking at performance over time, and making sure you look for a long enough period of time, and looking at bad years as well as good, looking at challenging points in the market. It's really easy to look smart in a bull market from a public market perspective, for example, but actually managing the downside in a more challenging market, almost more important. um, and then I think the like anything, there's a bit about the human that you're going to be working with and trusting. This is a really high trust relationship, so making sure you spend enough time with them, feel comfortable with them, don't feel under pressure, feel that they understand and personalize. Good wealth manager will understand your personal situation and won't be just generically shoving you into products, as well. Yeah, and it comes a bit from what I said at the start, which was recommendations, but to the extent that there are references that you can take as well. Again, a good wealth manager will be very happy for you to speak to one or two other clients, to understand how they work, how happy they are, how to work best with them, etc.
Yeah, this is extremely important because there are a lot of wealth advisors that are not working, in my opinion, in the best interest of the
Agreed.
athletes, especially.
Agreed. Agreed.
Well, okay, Nikki, it's time for us to wrap this up, but just before we do it, it's time for our last question, and it is, I want you to give us, because in my opinion, education is where everything starts, especially in the investing world.
Yeah.
So tell us, what are your book favorites that you want to recommend to athletes?
Um, can I do more than one?
as much as you want.
Okay, so I would go, maybe not such an obvious one, for Thinking Fast and Slow by David. David? Maybe it's not David. Kahneman is the author. It's not a finance book per se, but it's the psychology of decision making, and it explains most investing mistakes better than finance books do, in my opinion. Shoe Dog, Phil Knight, so the Nike founder, and I've got a personal soft spot for him because he's a Stanford alum and he spoke at my graduation ceremony at Stanford. And again, it's not about investing, but it's about building something from nothing with uncertainty at every step. Probably a bit more relevant for kind of athlete entrepreneurs. And then my final one would be The Algebra of Happiness by Scott Galloway. And it's good on money in the context of life, not just a portfolio. And Scott Galloway is someone he has a podcast as well, Prof. Galloway, which I also really like, talking about, lots of it, I call him philosophy of life, would be what that podcast is about. So that's another good one as well.
I like him as well, to be honest, Scott Galloway, and I think he also provides some really valuable lessons in his podcast.
Yeah.
I want to thank you. I want to appreciate your time, and I want to appreciate also the knowledge and all the information that you shared, because I'm sure it provided a lot of value for our audience.
Pleasure. Really good to speak, Nicola.